Welcome back to the Ideal Wealth Grower YouTube channel. My name is Axel Meyerhöfer. I'm the founder of Ideal Wealth Grower and the host of today's episode. And in our series, Terminology Explained, today we want to talk about a topic that is probably going to be quite interesting for the audience, and that is the topic of the unsecured loan. And I want to make you aware of what that is and how does it fit into the bigger picture. Most people will actually be familiar with, without necessarily knowing it, what is a secured loan. And what that means is secured in the sense of somehow the lender, the entity that is actually giving you the money, knows that you have the ability to pay the loan, meaning interest and principal, back on it. So how would that look like in the real world? What is a true example? A real world example would be that you have actually a house identified that you would like to buy so that you can move in, and you go to the bank that you're working with, and the bank people say, okay, well, if you want a mortgage, we need all this kind of documentation. What's your income? Do you have loans? Do you have credit cards? Do you have a car loan? Do you have any other obligations? And then also show us your pay stubs and maybe your tax returns from the last few years, so we can see what was your financial behavior and what is your income and what are your expenses. And they also apply a couple of different rules and so forth. And what they then actually find out is the ratio between how much money you actually bring in versus how much it would cost if you were to actually have that mortgage and would pay it on a monthly basis. And most people apply for either 30-year mortgage, so 360 months, or 15-year mortgage. And that means every month you will have the exact same payment. And the assumption at the very start of looking at that approval process is to say, can you afford that loan? So in a way, when you say, why is it secured? It is secured because of your creditworthiness and trustworthiness to make the payments. And if the bank or the lender says, yep, this person that is who is applying here for this mortgage is trustworthy, the ratio is, and most people would say, if you do the research, that what is kind of allowed these days is up to 50%. So give you an example, if your family total income that you're really actually receiving, the net income, would be $5,000, then 50% would mean $2,500 a month of that can go to pay the mortgage. And included in the mortgage, most people would say it's not just the principal and interest, but you will also have to pay property taxes, insurance, and all the things that are related to the house. So that would be a secured loan. Now, what in comparison is an unsecured loan? Or sometimes you might hear something called a no documentation loan, or also another term that is called a non-recourse loan. So why is it called non-recourse? As the first example is because this loan is given to you, or the mortgage is given to you, not based on your income, and therefore the lender cannot come to you afterwards and say, well, we want to get access to your income, because the loan was from the get-go non-recourse. They can't turn around and get the money based on your income. So where's the money then coming from to pay for the loan? Well, that money has to come out of the performance of the property. And that's why non-recourse loans and non-documentation loans are typically used for investment properties, where you, like we suggest with our out-of-state residential real estate turnkey investment strategy, you would buy a property that is performing well, and you would have a tenant in it that is managed by your property management company. And so with that in mind, what would actually happen is that the performance of this property, meaning like you getting rent income in, and from the rent, the mortgage is paid, property management is paid, the property taxes are paid, the insurance is paid, a little bit reserve is put aside, and then you either break even, or maybe you even have a little bit, $100, $200, $300 left at the end of the month. And with all of that working, you could basically say the loan or the mortgage is not really dependent on your income and your expenses. It's totally dependent on the property. Non-documentation in the same context, so the one is called non-recourse, the other one is called non-documentation, is it has nothing to do what you can show about your credit score or your income or anything like that. It has only to do with how the property performs. Now, what are the differences? In non-recourse loans, most of the time the down payment is about 50%. in non-documentation loans, it's really a matter of the lender. What I've seen is down payments of about 30%. So if you compare that to a regular secured loan, then you would get down to 20% or in some cases even 10% down payment. And if you do it for yourself as your own residency, let's say you're a first-time home buyer, I've seen examples of 3 or 5% down payment. On, like I said, investment properties where you put a tenant in, the lowest I've ever seen is 10%, more common is 20%. Right, and then if you do refi, it's 25%, and in some cases, like if you're not a citizen or so forth, might be 30%. But it's typically for non-documentation or secured, those down payments are significantly lower. If you go non-recourse, it's 50%, and that is definitely a much larger amount. And why is that important? Why would you ever consider to do an unsecured loan versus a secured loan? Well, two reasons. One could be that your income is so low because you had a bad year or there was a pandemic or whatever, that you would not qualify for a secured loan. But you may have saved money that you want to use to invest into this investment property, and then a no-doc or a no-recourse loan might work, because it doesn't matter how much income you had in the last year or what's in your tax return. The other thing is that you might just want to work with another lender. And the last thing I want to say has to do with the 10 gold tickets. Every person in the United States has basically the right to have 10 secured loans or 10 secured mortgages from government entities like Freddie Mac, Fannie Mae, or other FHA kind of organizations. But 10 is the maximum you can have. And so if you are on your investing journey and you have been investing for a while, and you have already used all 10, then you basically have no other choice to either go to commercial loans, which normally don't really get used very much in residential real estate, or you go non-recourse or no-doc, because that's the alternative to investing, and it really, as I said, has nothing to do with your income. So I hope this explains what most people are familiar with are secured loans, and what we learned about today is when you ever hear what is an unsecured loan, it means it's purely focused on how well is the property performing. It has nothing to do with your income. So I hope this helps you to understand what this means. If you're not already a subscriber, I would like to ask you to subscribe, ring the notification bell so you get notified when we have more videos coming out, and give it a thumbs up if you like the video and share it with your network. And the last thing I want to say is we recently started a podcast. If you like the topics and the things that you find here on our YouTube channel and you would like to be a guest to discuss with me what's on your mind about investing, ask your questions, or maybe you have a certain investing approach that you would like to talk to me about in our Ideal Investor Show, and then also have the audience learn about it. So please contact us in the description below or in the show notes, and we will reach out to you and get back to you and then make that happen. So with that being said, be well, stay safe, and I'll see you in the next video.